even one confusing one that falls into two categories, and we'll talk about that on next Thursday. So our first type of tax, this is an easier one to understand. It's called a proportional. A proportional tax. So in a proportional tax, everyone pays the same tax rate. So we're going to throw kind of a side definition in here. When we talk about tax rate, we're talking about a percentage. So tax rate is always a percentage. So in Flagstaff, your sales tax is 9.95%. That's a tax rate. Your income tax is going to be anywhere from 0 to 39%. That's a tax rate. So anytime you see a percent, you're talking about a tax rate. So percent tax rate. Probably already knew that, but just to simplify everything. So everyone pays the same tax rate, same tax percentage, no matter what. Anybody think of, and this is already one we've mentioned, think of a tax where everybody pays the same percentage. And feel free to yell it out if you know it.
The sales tax.
Yep, that is correct. Sales tax is a perfect example of a proportional tax. Everyone pays the same tax rate.
What about for things like with Arizona, how they just legalized marijuana? Like I pay, since I've had my medical marijuana card, I pay a lower sales tax than people who don't have their medical card.
So that is, it's classified as being two different, so it's the same product, but it's classified as two different products. Medical and recreational are, although it's marijuana, medical and recreational are considered to be two different products, even though they're the same thing. So you've got one tax rate that's on medical, and then one tax rate that's much higher that's on recreational.
Okay.
So, and of course, the way around the recreational tax is just to get your medical card. Don't write that down, but store that in your head for later use. Adam didn't tell you that. All right. Does that make sense? Does that answer your question?
I got a question.
Yep.
How come some reservation they don't pay taxes like groceries, gas, and stuff like that? And
so those are all state taxes or county taxes, and for tax purposes, reservations are actually considered to be a separate country. So you've got some federal taxes you'll pay, but not state, or not a different country. I mean, that's not a term. A different, almost a state of their own.
Yeah.
So you're exempt from most state taxes, county taxes, and then city taxes. Some reservations, and this is more on the East Coast, will have a specific reservation tax that's very similar to our county tax through sales tax.
Because I know that the Navajo Nation, they started taxing about, I say, mid-2000 or the early 2000. They started taxing gas and stuff like that to the people.
Each reservation can, they're their own, it's called a tax district. They can decide on their own taxes. Kind of like Flagstaff can decide on what they tax, even though they still have to charge what the state taxes, as well as federal, whereas reservations don't have to charge state or county taxes. They have to charge some federal taxes, and then each reservation can charge their own taxes. So they're their own taxing body. So they can choose whatever they want to charge, to tax. All right, so that's a proportional. Everyone pays the same tax rate. Perfect example of proportional tax is a sales tax. Questions on that before we move on? That's a pretty easy one to understand. All right. Next one is a progressive tax. We're still going to be talking about tax rates here, but we're going to compare them now to income. With a progressive tax, as income increases, tax rate, and again, tax rate, we're talking about percentage, increases. Well, let's keep this standard. Let's use arrows. I like arrows better than words. There we go. So as your income goes up, your tax rate goes up. And the inverse of this is also true. As income decreases, your tax rate also decreases. So another way of saying this is income and tax rate move in the same direction. There is only currently one type of progressive tax in the United States, as well as in almost every other country. Can you guess which one it is?
Income.
Income tax. Good guess / not guess. You knew that already. I'm going to assume you knew that. You weren't just guessing. All right, income tax. So income tax is the only progressive, and there are a number of different types of income taxes, but income tax is the only progressive tax. We're going to spend all day on Tuesday, not all day, all class on Tuesday, looking at how progressive taxes work. They can be a bit confusing, and that's why we spend a whole class on this. And because they can be a bit confusing, this is very often too why people don't understand how they work. So I'm going to simplify and help you understand how it works. So income tax is progressive, and income tax around the world is progressive. Pretty much every country uses a progressive income tax format. Questions on progressive, just the definition, not necessarily how they work. All right, like I said, after class on Tuesday, you'll be nauseated by how well you know how progressive taxes work. It's not an easy concept. I've got a way to teach it that makes it a little bit easier, but it's not, it's just not an easy concept. So we'll spend some time on that.
Can you scroll back up for a moment?
Yep, here we go. All right, so the third type that we're talking about, this one tends to be a little confusing until you get some examples for it. And at first it sounds really, really bad. So this one is a regressive tax. Regressive tax is the opposite of progressive. As income increases, tax rate, there's your percentage of tax you pay, decreases. As income goes up, tax rate goes down. And inverse is also true. As your income goes down, your tax rate goes up. So regressive is kind of the opposite of progressive. With progressive, tax rate and income move in the same direction. With regressive, tax rate and income move in opposite directions. Now, most people kind of look at that and go, well, that doesn't seem fair at all. So the more I make, the lower tax rate I pay, but the less I make, the higher tax rate I pay. And you're probably pretty right in looking at something like that. So what we're going to do is we're going to give you some examples. And I'm going to give you some examples. They're going to be a little bit far-fetched, but not far-fetched, but the numbers are going to be far-fetched. But I'm doing it to illustrate a concept so we don't get bogged down in math. All right, we're going to decide that I want to go fishing. So me is Adam. I want to go fishing. Does anybody know how much a fishing license costs? Just a basic fishing license in Arizona costs?
Like $50. I don't know.
15.
If-
For the very, very, very basic, no tags or anything. All right. Is a fishing license a tax? Yes. That money
It's a
goes
go-to.
to Arizona Fish and Game, which is a state government organization. So it's a tax. So we've established that if I want to go fishing, I have to pay tax on that. And I have to pay $15 tax. Now, when I go to get my fishing license, which I can get, they actually do finally, I think, have it online now, but you can usually go to most supermarkets and they will sell you the basic one. Are they going to ask me how much I earn when I get my fishing license? No, they don't care. All they're going to say is this costs $15. So I'm going to use, like I said, this is an extreme example, but it's to really illustrate this fact. Let's say that my income for the year is $15. It is more than that, but for argument's sake, we're going to say that my entire income for the year is $15. When I buy my fishing license, what percentage of my total income have I paid in that tax?
100.
100%.
100%. So now I just paid a 100% tax. And that's our rate because it is a percentage. That's a 100% tax rate. I just spent all my money on a fishing license. So I also decide, you know what? Fishing seems kind of lonely. So I want to go with my friend. I'm going to take a friend fishing with me. We're going to take my other friend who works here at the school. Kelly teaches biology. He's my climbing partner, but I don't really fish. I do more rock climbing, but we're going to say I fish with this because there's no tax on rock climbing. So Kelly, I'm going to make him go fishing with me. Now he teaches science, which is way, way more important than economics. And he teaches biology, which apparently is really more important. So he makes twice as much as I do. He's really, really productive here at the school. He makes $30 a year. Now he's got to buy the same fishing license because he's got to go fishing. So he's going to buy that same fishing license. Now, what percentage of his salary just went to that fishing license?
50.
50%, correct. 50% tax rate. Now, we paid the same dollar amount, right? We both paid $15, but that $15 represented a different percentage of our total income. So let's see what happened here. Let's highlight some stuff. So here I am at my lowly $15 a year. I paid 100% tax rate. Kelly, he's a scientist, so he makes more money than me. He only paid a 50% tax rate, but we both paid the same dollar amount. So if we look at what happens here, as our income increased, so from 15 to 30, we had an increase in income. Our tax rate went from 100 down to 50. So fishing license is a regressive tax.
So does this just refer to a tax that never changes in price, and is that a set price?
Correct. That's exactly how you determine if it's a regressive tax or not.
How come sales tax isn't like that? Wouldn't it be the same situation? Like you're getting the same rate, but someone might make more or less?
They are, but it's a percentage of the dollar amount that you've paid.
Okay.
Whereas this isn't a percentage of a dollar amount you paid. This is a fixed dollar amount. So the amount of sales tax you pay is not a fixed dollar amount. It's a percentage of the dollar amount that you spend on taxable services or goods and services.
So the
In this
difference
case-
between the two would be one would be a fixed percent and the other one is a fixed dollar amount.
Correct. And that's your key for regressive. Anytime it's a fixed dollar amount, you have a regressive tax. Does anybody not see how that math worked out? And like I said, I kept the numbers really, really simple because I want you to focus on the concept, not on all the amount of division that is going on, things like that. All right, can anybody think of, and this is kind of a challenge, think of an example of a regressive tax.
Driver's license.
Perfect, driver's license.
Speeding or parking tickets.
All right, tickets.
I was going to say parking tickets too, but I was thinking, do they depend on the city as well? Does it matter if it's different prices in different cities and states?
No, it would be, so if I get a parking ticket in Flagstaff and you get a parking ticket in Flagstaff, that's going to be the same amount. So you're not necessarily going to compare it with if I get a parking ticket in Flagstaff and you get a parking ticket in Manhattan, which is going to be much more expensive than Flagstaff.
What about property tax? Is that based on
That's going to be based on the value of the property.
okay.
So it's not a fixed dollar amount. It doesn't change it changes briefly, but the property tax is going to be proportional tax. So it's a percentage of the value of the property. So I think it's 0.75%. That's what we have here. I live in Yavapai County. So we're at, I think, 0.75% of the assessed value of the property, not the actual value of the property.
What about court fees?
Perfect. Court fees. Here's one that nobody ever comes up with. How about the postage stamp? I think postage stamp costs 50 cents now. I don't know because I haven't bought one in like 20 years. But I think they're at 50 cents now. That goes to the US Post Office, which is a government entity. Therefore, a postage stamp is a tax.
It's an optional tax though. Like
Well, what
don't
you
have-
find with regressive taxes, and that's a key right there too, most of these are optional. Now, that's not to say
I'm pretty
that
sure tickets are optional too, just don't get them.
tickets are optional, court fees are optional. I mean, you can argue driver's license maybe not optional, but you know, technically it is. You know, and fishing license, we're not saying a fishing license is optional if you want to fish, but wanting to fish is the option. So generally, these are regressive taxes are things that are not really required to survive. And again, I would highly question driver's license as being not really, I guess it's not required to survive. It's just a little difficult if you don't have one.
Depends on the microeconomy you're in.
Depends on where you, yeah. If you live in Manhattan, you can do very well without ever getting a driver's license. If you
Only
live
if everywhere's public transport was as good as Japan.
yeah. So if you live in Flagstaff, highly recommend having a driver's license. I know the mountain line is okay, but not the best. All right. So anytime you have a fixed dollar amount, that's going to be a regressive tax. Park entry fee. If you go to one of the Arizona state parks, you'll pay like $7 or something to get in. That's a regressive tax that goes to the state. Or if you go to a national park, that goes to federal government. So all taxes that exist fall into one of these three categories. And like I said, there is one that falls into two of these, which we'll get into next Thursday. Questions on any of these concepts? All right.
So
Yeah, go ahead.
Don't know if I'm jumping the gun on it, but don't we kind of have a weird situation with the income tax in the US? If it actually goes down at the higher level, like the highest levels of income?
Doesn't
Or is there
doesn't
like
go
something
down
more
high.
to it why people say the richest don't really pay much tax?
So there's a couple things with that. One is our progressive tax system. It goes anywhere from 10% to 39%. So the higher income tax will go. There are a number of different types of income taxes. So you pay income tax, you can also pay capital gains tax, which is income that you earn, not necessarily from working, but from investments. So money that you make on the stock market, or if you sell a business, or any other number of investments. That tends to get taxed at a lower percentage than income tax. Generally, very, very wealthy. I'm not talking about like top 10%, like the top 0.01%. Most of their income is not going to come from a salary. It's going to come from investments, and that tends to be at a lower percentage. And the other thing, and this is not for or against that argument, it's interesting when you hear that, and there's definitely examples. How does this wealthy person not pay taxes? Well, you can be wealthy and not have income. You pay tax on income, not on wealth. So there's a number of ways that you can become wealthy without actually earning income. You can get an inheritance of, we just looked at, so $11.5 million. So if somebody hands you $11.5 million right now, some long lost uncle, you'd probably be pretty excited, right? I just got $11.5 million. You don't start paying taxes on that until you hit $11.6 million. So now you just received $11.5 million that you don't have to pay taxes on. You are now classified as wealthy with $11.5 million. You now have wealth, but no income.
Hold up, but if you get an inheritance like that, it's usually invested in something like even a money market account. So when you withdraw it, you'll have to pay taxes on it, correct?
No, that money is yours. Any interest you earn on that money, you'll get taxed on. So if you put that money into the stock market and you earn money on that, you'll get taxed on that. You get taxed on your gains, but you're not going to get taxed on that initial $11.5 million or $11.6 million. But now you're classified as wealthy because you have $11.5 million and you haven't paid taxes on that. So that's one thing. And the other thing is the IRS has tons of data that nobody really wants to look at to see how much tax people pay at different levels. And it tells a little bit different of a story. And that's always one thing. I never try to, anytime somebody talks about an opinion, I never ever want to talk somebody out of that opinion. I'm never trying to change anybody's mind. More, what I want to do is, okay, if this is your opinion, let's find data that backs that up. Like let's not just have a pie in the sky opinion. And it's interesting when you look at the numbers, and I've got a ton of this data from the IRS. So the top 1% of wage earners in the country, this is not wealth holders, this is wage earners, so people that earn money. So the top 1%, which puts you at earning $420,000 a year or more, which is a lot of money. So that group last year, or 2019, the numbers haven't come out for 2020 yet. In 2019, they paid 39% of all taxes. So you have 1% of wage earners that paid 39% of all taxes. When you take the top 50% of all wage earners in the country, which is basically anybody that earns $27,000 a year or more, you're in the top 50% of all wage earners, they paid 97.5% of all taxes. So, you hear stuff like the wealthy don't pay enough taxes. I would say, don't change your mind on that, but what do you mean by wealthy and what do you mean by not enough? And that's always the question I have is, what's not enough? What should it be? What should the top 1% of all wage earners pay in taxes? And if you say, I think they should pay 100% of all taxes, well, okay, so there's your argument. But at least, don't just say, a lot of people like to come up with arguments and they're very broad terms. The wealthy don't pay enough. Well, okay, define wealthy, define not enough, and then define what should it be. That's how you make a solid argument for something. Look at and that's kind of what hopefully you'll get out of this class. But yeah, there's a lot of stuff, a lot of interesting stuff, data if you want to look at it for who pays what taxes. All right, you guys want to have some story time? It's gonna be like elementary school, story time. Okay, questions on these concepts before we get into story time. All right, so here's story time. We're going to talk a little bit about income tax. Here is a tax that probably most of you at some point have already paid. And if you haven't yet, at some point in your life, you probably will. So it's very, very few people never pay any kind of income tax. So before we get into the numbers and looking at how we calculate percentages and what the income tax rates are, I think it's important to understand how income tax currently works now, and a little bit about the history of income tax. Because here's something we never cover in history class: is what's the history of income tax? You know, it wasn't just one day people in the federal government woke up and they were like, "Hey, this is what we should do." Everything has a story, and I think this is a pretty fascinating story of why we have income tax and why it's kind of this convoluted system of your employer takes some money out, and at the end of the year, you have to go back and say, well, you either didn't take out enough or you took out too much, and then the federal government has to pay you back, or you have to pay the federal government some money. You know, why is it so confusing that way? And you know, a lot of people, and it gets into this conspiracy thing all the time of, well, we make it confusing to keep people confused so they don't question things. And what we find is there's usually a lot more accurate of a story behind this stuff. Why do we have this confusing thing? So that's what we're going to talk about a little bit, the history of income tax, some of the players. This is a short story, but I find it kind of fascinating. So prior to 1913, that's a year. That's not a tax rate. Prior to the year 1913, there was no income tax in the United States. No income tax at all. The federal government was funded by two main sources. The big main source that they got their tax revenue from were tariffs. And tariffs are simply a tax on stuff that's being imported, a tax on stuff that's being brought into the country. We'll talk about tariffs at the end of class, like at the end of the semester when we get into international finance or international economics. But tariffs have been around forever. I mean, tariffs have been around. The earliest recorded tariffs were back in the 1200s. So this is kind of one of basically the original tax was a tariff. So you tax stuff that's being brought into the country from another country. That's how the US government got most of their revenue. The additional revenue came from a use tax on tobacco. There's a tax on shipping and a tax on railroads. So that was it. So if you put something in a rail car, it got taxed. You put something in a boat, it got taxed. And if you use tobacco, paid a tax on that. Pretty simple. So 1913 came around, and so this is a global history question. There was a big global event brewing 1913, 1914.
The Depression?
Not yet. World War I.
Oh,
World War I. So this is pretty big. And they knew there was going to be a second one, and they wouldn't have called it World War I, right? No, that's a
it's
history.
called the Great War then.
It was called the Great War. I try to throw those history jokes.
War to end all.
And the war to end all wars. Boy, were they wrong.
No kidding. Sorry, I took what you said very seriously. My bad.
All right, so World War I. This meant U.S. was bound to get involved. So federal government said, we're going to need to find another source of tax revenue. Because right now, we're not going to have enough to get involved in a war that has a lot of new technology at the time. There was a lot of new combatant technology. So we're going to have to spend a lot of money. We need to find another source of revenue. So in 1913, they passed the 16th Amendment to the Constitution, which allowed the federal government to levy and collect an income tax. or a tax on the amount of money people got paid. So 1914 was the first year. It was passed in 1913. 1914 was the first year that any income tax existed in the United States. Federal income tax existed in the United States. And it was a pretty basic tax, and it really wasn't paid by a whole lot of people. So essentially, only about 0.5%, and you don't worry about the specifics of these numbers, but only about 0.5% of the entire population paid any tax at all. So basically, this was a tax on the wealthiest of wealthy individuals, the highest earners. And I've got a copy, I don't have it here, it's in my office, of the original tax rates. And basically what it was it was the equivalent of anybody who made what would be the modern equivalent of about $350,000 a year or more at the time. At the time, it was $20,000 a year, but that's the equivalent of about $350,000 a year. So it was only a tax on really, really, really high wage earners. And at this point, it was interesting. There was fewer than 2,000 people that paid taxes in the entire country that year. Very, very small number of people paid taxes. And the tax rates were really, really low. They were anywhere from 1% to 5% of your income. So extremely low, and extremely few people paid it in 1914. So most people weren't even aware that there was a tax, or if they were aware, they didn't really care because it was so far out of their realm. So it got passed, people got taxed, and it worked that way from 1914 to about 1941. Now, between those years, 1914 and 1941, they changed a little bit. So the tax rates increased a little bit, and the number of people who had to pay increased a little bit, but not much. Still, at this point, by about 1941, you only had about 15% of the population paying any income tax at all. So still a pretty small amount. Now, back then, the process was really, really easy. In fact, it was super, super easy. All you did was, at the end of the year, you said you added up how much money did you get paid this year, and that was an amount. And then you would determine, are you going to pay 1%, 2%, 3%, 4%, depending on how much you made. And then you would write a check and mail it to the federal government. So super, super easy. How much did you make at the end of the year? Cool. Mail 1 or 2 or 3% of that to the federal government. Boom, your taxes are paid. Super easy. No accountants needed, no anything needed. Kept it nice and simple. Pretty basic. So that worked well if you could manage your money, knowing very well that, hey, sometime in January, you're going to have to write a check that's going to be for a few percent of it could be kind of a pretty big check. So make sure you have at least that amount saved in your bank account. So that's how it worked from 1914 to 1941. Super easy, barely anybody was even required to pay. Then 1941 rolled around. And what global event was getting ready to start in 1941?
World War II.
World War II. Same thing, U.S. is getting involved. Federal government says, you know what? We are going to need more money for this. So we need to start taxing more people. So starting in passing the legislation in 1941, supposedly starting in 1942, created what was called the mass tax. Mass simply meaning everyone. So he said, all right, we're going to start charging everybody income tax. Now, if you're not making a lot, don't worry. You're only going to have to pay a tiny, tiny percentage of your income if you're not that high of a wage earner. As you earn more money, you're going to get taxed at a higher and higher rate. So those of you not making that much money, don't worry. It's going to be pennies on the dollar, if that. You're not going to pay a ton. But What this meant was now you've got about 85% of the population. This is the first time ever in their lives they're going to have to pay income tax. So Midway passed this law early 1941. So 1942 rolled around. This was the first year that the tax was actually going to get levied on people. So somewhere around May or June in 1942, federal government said, you know what? We want to go ahead and make sure people are saving up money because at the end of the year, they're going to have a tax bill. So they did a huge survey around the country, and they surveyed tens of thousands of people. And basically they said, hey, just so you know, remember there's this income tax, you may have read about or heard about it. You're going to be paying that. So at the end of the year, are you going to have enough money saved up to pay this tax? 90% of the population said no. I'm not saving up money. I probably will not have the money to pay this tax. So that was a bad thing. So that's when the federal government realized, okay, this might not work. At the end of the year, if people don't have money, there's not much we can do. We can't throw 90% of the population in jail for tax fraud or tax evasion. So we've got to figure out something. We need a solution. So that's where they brought in their finance brain. And here's one of my favorite characters in all of history who never makes it in any of the history books. Beardsley Rummel. If you get a chance, look him up. Fascinating individual. So here's our character, Beardsley Rummel. So here's Beardsley Rummel. Quick bio for him. He started out as a psychologist. He actually got his PhD in psychology from University of Chicago. And he did a whole lot of research on consumer behavior. So when he graduated kind of in the 1920s and started his practice in the 1920s, which was known as the Roaring 20s. This is kind of the birth of consumer spending. Prior to the 1920s, most people didn't have a lot of consumer income. Most people were farm. 80% of the population was farmers. In the 1920s, you saw the advent of consumer spending. You saw things like clothing and appliances and cars. All these things were now available. People were buying. So Beardsley Rummel, as a psychologist, he studied consumer behavior. He said, people are making choices that we've never seen in history before. And I want to study what goes on in people's brains when they make these choices. So that's what he did. He kind of focused on consumer behavior. And he was kind of the founder of consumer behavior. So in the 1930s, he got a little bored and fed up with psychology and decided to go into business. And he took the knowledge he had of consumer behavior and decided he was going to go into business. And he made a big name for himself in business. He was what we would call the chief financial officer today. They called it treasurer back then, but basically the head of accounting and finance and anything numbers related for the largest retailer in the entire country, which was the W.H. Macy Corporation. So he was the head money guy. Does anybody know what we currently call the W.H. Macy Corporation?
Wells Fargo?
We now call it Macy's, which is a perfect example of a dying company. In the 1930s, they were the largest. They were basically, in the 1930s, they were the Walmart and Amazon of the United States. Now they're the Sears and Blockbuster Video of the United States. So he was basically headed up the money guy for Macy's Corporation. He also worked for the federal government. He did consulting for the federal government, helping out with the Treasury Department on anything that involved money. So pretty smart guy, pretty powerful. So federal government at the time, it was FDR was president. He said, Beardsley, we have a problem. So nobody's going to pay taxes this year because nobody's planning for this. It's going to screw everybody over. So Beardsley said, you know what? I've got an idea. I've got an idea for how we can make people pay taxes. He said, here's what I know so far about how the human brain works. He said, I invented this thing at Macy's, and this is true. He invented concept of layaway. If you're not as old as me, you've probably never heard of or experienced layaway at a retail store. Does anybody know what layaway is?
It's like they'll hold something for you while you make payments, right?
Yeah, yep. It was basically the forerunner of corporate credit or consumer credit. So in layaway, the way layaway worked was, let's say you want to buy a furniture set. You go into Macy's and you want to buy a furniture set. You're like, well, that furniture set's $100. I don't have $100. I guess I can't buy it. Beardsley Rummel came up with a new idea. He was basically the father of consumer credit. He said, wait, don't leave yet. Here's what we're going to do. We're going to go ahead and put a sold sign on this furniture set that you want. And you're going to make payments. You're going to pay us $10 a week for the next 10 weeks. Then when you paid that $100, you're going to take that furniture set home with you. So what he learned in all of his research for consumer, understanding consumer psychology, was that people are good at making small payments on things. They're not necessarily good at saving up for a long time and then using that money to buy something. And as you can tell, people have not changed. So Beardsley Rummel knew this. He invented layaway. That's one of the reasons why Macy's got to be so big. So he said, we're going to do a version of layaway, but for taxes. He said, here's what we're going to do. We're going to change things around. We're not going to have people make them save up money all year so they can make this payment at the end of the year. So we're going to change things around. We're going to put the responsibility of tax collection on employers. And what the employers are going to be required to do is, before they pay employees their wages, they're going to be required to take a little chunk out and send that to the federal government as a payment. So now people are making payments on their taxes not once a year, but every week or every 2 weeks. They're making small payments. And that's how we started in the middle of 1942. It was up to the employers to start pulling money out directly, and this is how it works today, and sending that money to the federal government. And they said, well, wait, we don't really know how much they have to pay until the end, because it's going to be based on their income. And you don't know how much you're going to make until the end of the year. So Beardsley Rummel said, yep, we've got that situated. What's going to happen is, at the end of the year, we're going to say you earn this much. This means you earn this much taxes, but you've already paid a bunch of them. So either you're going to have to pay a small amount more if your employer didn't take out enough, or if your employer took out too much, we're going to send you back the amount that you overpaid, because we're not going to charge you more than you owe. So essentially what happens is the government is giving you back your change. If you think way back in the day when you used to buy stuff with cash, you go to Starbucks, your bill is $5.50. You hand them a $10 bill, they give you back $4.50. They're giving you back your change. Well, that's the same way the tax returns work. Your employer is taking out little bits of money every paycheck. At the end of the year, you have to figure out what you actually owe compared to how much you've already paid. If you've paid too much, government says, oh, you overpaid us. Here's your change. Here's the amount you overpaid us back. So that's kind of how we are, where we are today when it comes to taxes. And this always kind of blows my mind of, we're going to see this in the next couple of months. You're going to see advertisements all over the place of, hey, spend your tax return here, spend this here. And I can't tell you how many times I've heard people say, oh, I didn't pay any taxes last year. I got money back. Or look, the government just gave me $500 as a tax refund. They didn't give you any money. They gave you the amount of money that you overpaid back to you. So tax return is your change. Keep that in mind for the rest of your life. That's your change. You overpaid, they owed you money. And you had to wait a year to get it too. Always another fun thing. So that's kind of where we are for history of income tax. Any questions on that? All right. So on Tuesday, we are going to look at how we calculate income tax through income tax brackets. You're definitely going to want to have a calculator for this. The math, we're going to use actual numbers, which are a little bit bigger, and this is going to definitely require a calculator. Please use a calculator. That's what we're going to do all day Tuesdays. We're going to see how to calculate federal income tax. Other than that, I'm going to stay on if you guys have any questions. If not,